If you set clear rules for how you invest and then break those rules from emotional reasons, that's no longer investing. That becomes gambling every single time. And that brings us to today's question. What looks like investing, but it's actually gambling? Welcome, friends. I'm Fred. Here we talk about investment, business, real life, and training, all from my personal perspective. This topic is more dangerous than it looks because many decisions feel strategic, rational, and intelligent, but deep down, they are emotional bets disguised as investing. Recently, I was comparing three different investment strategies, and even though comparing strategies is not the main point of this video, I want to use that comparison to illustrate how something can look like strategy, but actually be gambling. Three common investment strategies. The first strategy is inspired by John Bogle, the idea of investing in ETFs, especially broad market ETFs. For example, investing in an ETF that tracks the S&P 500 or building a global ETF portfolio tracking both developed and emerging markets. The philosophy here is simple: buy, hold, stay invested, avoid emotional decisions. The second strategy is stock picking with a buy and hold mindset. For example, you build a portfolio around 20 companies. Your intention is to buy and hold for many years. You only sell if a company fundamentally deteriorates over a long period. Again, the rule is clear. You are not trading, you are owning businesses. You are thinking long term. Now, the third strategy is based on Joel Greenblatt's magic formula. The idea here is buy good companies that are temporarily undervalued. Focus on companies with strong fundamentals but weak short term sentiment. Rebalance once per year, adjusting the portfolio weights. Maintain discipline instead of reacting to market noise. This strategy is also rule based and designed to remove emotional from decisions. The key point: all real strategies have rules. These three strategies are different. They have different philosophies, different selection criteria, and different mechanics. But they share one crucial thing: they are all built on clear, predefined rules. And here's the central message of this video: the moment you break your own rules for emotional reasons, your investment turns into a gamble. When strategy turns into gambling, let's look at real examples. Magic formula, Joel Greenblatt. If your strategy says rebalance once per year, but you start buying and selling between rebalancing periods because you feel nervous, you feel excited, you think a stock is too hot, you feel something is about to change, you are no longer following the strategy, you are betting. It might feel smart, it might feel justified, but the truth is, you left the system. Stock picking, buy and hold. The the second strategy. If your plan is buy strong companies, hold long term, but you suddenly sell because you think another stock looks better, you want to time the market, you feel fear, you feel FOMO, you've moved from ownership to speculation. That decision may feel analytical, but it's often emotional driven. Gambling in disguise. ETFs strategy, John Bogle. If your strategy says hold ETFs long term, ignore currency, ignore swings, ignore short term macro noise, but you sell ETFs because the dollar is rising, the Brazilian real is weak, you think Brazilian assets will outperform, you want to rotate tactically, you just abandon discipline. Once again, strategy, emotional, gambling. The market is designed to break your discipline. One of the most important things to understand is this: the market will constantly try to pull you out of your strategy. Fear, greed, news, social pressure, expert options, expert opinions, short term performance. All of these exist to tempt you into emotional decisions. And most people fail because they don't realize that the real challenge is not choosing strategy, is sticking to it. Is sticking to your strategy that you choose. A shocking statistic about investors: that average Brazilian investor holds stocks for less than 1 year. In many cases, the average holding period is around 6 months. That means most people are not investing, they are reacting, they are trading emotionally, they are buying high and selling low. This behavior is not a strategy, it's impulse, pure impulse. The illusion of beating the market. Not long ago, I spoke with a bank manager who told me about a portfolio their bank manages, a so called top 5 portfolio. A portfolio containing only 5 stocks. They claim this portfolio outperforms the market significantly. Now, I am personally very skeptical of this type of claim. And why is that? Because I align more with John Bogle's philosophy, which argues that there is no strong long term evidence that most investors or fund managers can consistently beat the market over large time windows, such as 20 years, for example. Short term outperformance exists, but consistent long term outperform is extremely rare. So, when someone says, we always beat the market, we found a winning formula, this strategy is guaranteed, I treat it with serious caution. This is not about picking the best strategy. Notice something important. I am not saying that one of these strategies is objectively superior to the others. Each has its strengths. ETFs can be extremely efficient, especially with low fees. Stock picking can work if done carefully and rationally. The magic formula has historical data supporting its effectiveness. There are valid arguments for each approach, but that's not the core issue. The real issue: discipline over intelligence. The real question is not which strategy is the best. The real question is, can you follow strategy without breaking emotionally? Because even a great strategy fails without discipline. Even an average strategy can work if followed consistently. Most people don't lose money because they choose the wrong strategy. They lose money because they panic, they chase performance, they abandon rules, they trust their feelings instead of their system. Why emotional decision making fails? Some people say, I use rules in my trading. That sounds good in theory, but in practice, those rules are constantly tested. The market constantly pressures you. You constantly feel tempted to override your own plan. And when decisions depend on feelings, intuition, excitement, fear, the market will outplay you every time. Why day trading and swing trading usually fail? This is one of the main reasons why day trading, swing trading, short term speculative strategies tend to fail for most people because they require, think about that, constant discretionary decisions, constant emotional control, constant judgment under pressure. And the more decisions you make emotionally, the more you turn investing into gambling. The core message, let's simplify everything into one sentence. A true investment follows rules. A gamble follows emotions. If you define a strategy, create clear rules, commit to long-term discipline, you are investing. If you change your plan based on fear, buy or sell based on excitement, react to short-term news, override your own rules, you are gambling, even if it feels smart. Now, I want to hear from you. When do you think an investment stops being an investment and becomes a gamble? Share your thoughts in the comments. Thank you for following the channel. To everyone that is following, supporting the content, and thinking deeply about these ideas. See you in the next video, my friends.